Hello, everyone. Welcome to Unit 14, Chapter 3.4 on financing agricultural businesses. I'm excited to guide you through this comprehensive exploration of how agricultural enterprises can access, combine, and strategically manage the capital they need to grow and thrive. Today's session will transform how you approach financing decisions in agriculture. Unlike other sectors where financing is relatively straightforward, agricultural enterprises face a uniquely complex financial landscape, shaped by biological production cycles, multidimensional risk exposure, and a policy environment that is unlike anything you'll find in manufacturing or services. We're dealing with capital requirements that arise before a single euro of revenue is generated, repayment cycles dictated by harvests rather than monthly calendars, and collateral assets that are inherently difficult to value and secure. This isn't a generic finance module adapted for farming. It's a specialized framework built specifically for the realities of modern agricultural enterprises, with deep attention to the EU policy context and the full range of financing instruments available from traditional bank products to digital platforms and alternative mechanisms. By the end of our time together, you'll have practical tools and strategic frameworks you can immediately apply, whether you're financing the establishment of a new enterprise, planning the next investment phase, or building the long term financing portfolio that will support sustainable farm development. Let me set the context for what we'll cover and what you'll be able to do by the end of this unit. We have five core learning objectives. First, you'll be able to identify and compare the main financing categories available to agricultural enterprises, from self financing and bank credit to cooperative finance, microfinance, and alternative mechanisms. This comparative understanding is essential because no two financing instruments are truly equivalent. Second, you'll learn how to evaluate which instruments are suitable for each stage of the enterprise lifecycle, establishment, growth, and maturity, based on risk profile and capital needs. What works in year 1 looks very different from what works in year 10. Third, we'll go deeper into the subcategories within each financing type, because knowing that bank credit exists is not the same as understanding when to use a seasonal crop loan versus bridge financing versus agricultural leasing. The details matter enormously in practice. Fourth, we'll briefly explore the EU specific context, CAP direct payments, EAFRD grants, EIB programs, and financial engineering tools. These instruments are unique to European agriculture, and understanding how to leverage them is a genuine competitive advantage, and they are in depth developed in another unit. And fifth, you'll have the frameworks to build a diversified, balanced financing portfolio, integrating multiple complementary sources for sustainable farm development. The goal isn't to find one good loan, it's to construct a financing strategy that evolves alongside your enterprise. We begin with the foundation. Before exploring any specific financing instrument, we need to understand why agricultural financing is fundamentally different from financing in other sectors and why that difference demands a specialized approach. Section 3.4.1 addresses that question directly. Agriculture doesn't fit neatly into the financing models designed for manufacturing or services, and it's important to understand exactly why, because that mismatch is the source of most of the challenges farmers face when approaching banks, investors, or grant programs. Let me walk you through 6 characteristics that make agricultural finance genuinely unique. The first is capital intensity. Farming requires substantial upfront investment in land, machinery, seeds, irrigation, storage, and processing, often before a single euro of revenue is generated. You're committing capital today for returns that may arrive months later. That front loaded risk profile is unusual and creates real pressure during early production phases. The second is biological production cycles. Unlike a factory that runs continuously, agricultural output depends on living systems and seasons. Revenue is delayed, irregular, and concentrated around harvest periods, We create inherent mismatches with conventional loan repayment schedules designed for businesses with monthly cash flows. Third is multi risk exposure, weather variability, plant disease, pest pressure, and commodity price volatility don't just happen independently, they tend to hit simultaneously and are correlated. Standard credit models built for other industries systematically underestimate this compounded risk. Fourth is collateral complexity. Rural land values are harder to establish objectively, land titles may be unclear in many regions, and seasonal assets like crops still in the field are genuinely difficult to use as conventional security. This forces lenders to use specialized evaluation methods that many conventional banks simply don't have. Fifth, the rural financial ecosystem itself creates barriers: physical distance from bank branches, higher transaction costs for lenders, and in some areas, lower access to financial services that urban borrowers take for granted. And sixth, perhaps most distinctively in Europe, EU policy dependency. A significant share of farm income in many countries derives from cap direct payments and EFRD grants. This means financing decisions and EU policy cycles are deeply intertwined. Understanding one without the other gives you an incomplete picture. These six characteristics are why specialized financing approaches exist and why understanding them is the starting point for any serious agricultural financing strategy. One of the most important ideas in agricultural finance is that your financing needs aren't static. They evolve as the enterprise develops through distinct phases, and the right financing approach looks very different at each stage. We can identify four phases in the agricultural enterprise lifecycle. In the establishment phase, you're starting from scratch, minimal credit history, high perceived risk, limited revenue streams. The primary sources here are personal capital and family support, potentially supplemented by EU Young Farmer premiums under CAP, which can provide top ups of up to €100,000, as well as microfinance and EAFRD startup grants. Lenders are cautious at this stage, which is precisely why internal resources and public support instruments are so critical early on. In the growth phase, you've established revenue streams and your creditworthiness is improving. Medium term investment loans now become accessible for equipment acquisition. Leasing makes strategic sense for machinery and technology. Agricultural cooperatives become a complementary financing channel. EU co financing for modernization projects also opens up. The key shift is that you now have a track record to show. By the maturity phase, a strong financial history unlocks access to long term bank finance, revolving credit lines, factoring of receivables, and potentially participation in investment funds. Competitive rates become achievable because you've demonstrated sustained reliability. Retained earnings begin to play a primary internal financing role. Finally, the transition or succession phase has its own specific financing requirements: bridge financing for ownership transfer, mortgage restructuring, and rural development support to manage what is often a legally and financially complex generational handover. The key takeaway here is that financing strategy is not a one time decision you make and then set aside. It needs to evolve alongside your enterprise, matching the right instruments to each phase of development. We now turn to the first and most fundamental category of agricultural financing: self financing from internal resources. Before approaching any external lender or investor, understanding your own capital position is essential. Section 3.4.2 explores the three core mechanisms of self financing and, importantly, why they matter not just as funding sources but as signals to external partners. Self financing takes three main forms, each with distinct advantages and real limitations that need to be understood honestly. The first is personal capital investment, the entrepreneur's own equity. This is more than just a funding source, it's a signal. When you invest your own money, you demonstrate confidence in the venture, reduce the moral hazard risk that lenders worry about, and eliminate debt servicing costs during the most vulnerable early phases. The downside is clear. Personal resources are typically insufficient for major investments. They concentrate financial risk on you personally, and they can constrain how quickly you can grow. The second mechanism is retained earnings reinvestment, using profits from successful production cycles to fund future investments. This is the sustainable internal growth engine. It carries no external cost, and consistently reinvesting profits sends a strong signal to future lenders about financial discipline and long term viability. The constraint is equally clear. This approach is limited by profitability, meaning slower expansion and the opportunity cost of capital tied up in operations rather than deployed elsewhere. The third mechanism is asset liquidation and reallocation, selling underutilized land parcels, outdated equipment, or non core business segments to free up capital for strategic priorities. This can fund significant transitions without taking on new debt and improves overall capital efficiency, but it also means permanently losing strategic assets, potentially triggering tax liabilities, and sometimes disrupting ongoing operations. The key insight about self financing is that it's not passive capital management, it's active, and its value extends well beyond the capital itself. Strong internal financial position is what makes external financing accessible on better terms. Commercial banks remain the most widely used source of external agricultural financing across Europe. Section 3.4.3 breaks down the full range of bank credit products: short term seasonal loans, medium and long term investment credit, bridge financing, and agricultural leasing, and how each is structured to serve specific needs at different points in the agricultural production and investment cycle. Short term agricultural loans with maturities of up to 12 months are the working capital instrument of farming. They are designed to align with the production cycle, covering costs that arise before revenue is generated. What do these loans actually finance? The typical use cases include seeds, fertilizers, crop protection, and veterinary products, seasonal labor costs for planting and harvesting, equipment operating costs like fuel and maintenance, post harvest processing, storage, and transport expenses, crop insurance premiums, and sometimes land lease payments for additional production area. In short, everything you need to run a production cycle from soil preparation to sale. Repayment structures are more flexible than in other sectors, reflecting the reality of agricultural cash flows. Bullet repayment, a single payment at the end of the term, is common for single harvest crops. Installment schedules work better for operations with more distributed revenue across the year. Many products also include flexible provisions during low cash flow periods. For collateral, lenders typically work with what's available in the agricultural context. Future production rights, a structure known as a crop lien, stored inventory of inputs or outputs, accounts receivable from established buyers, and personal guarantees. Interest rates on short term agricultural lending are above long term secured loans, reflecting production cycle risk. It's worth noting that digital lending platforms are beginning to reduce processing times significantly. The World Bank estimated reductions of up to 40% as of 2021, which is particularly important for farmers who need access to credit within narrow seasonal windows. Access barriers remain real and significant, particularly for smallholders. Strict documentation requirements, short seasonal application windows, lack of credit history, and repayment dates that don't always align with actual market access. Understanding these barriers is as important as understanding the instruments themselves. When we move beyond working capital to capital formation, building the productive capacity of the farm over time, we enter the territory of medium and long term investment loans. Medium term loans, typically 3 to 7 years, cover equipment acquisition, tractors, harvesters, irrigation systems, breeding livestock, and minor infrastructure improvements. The purchased assets themselves often serve as collateral, and grace periods are common during the establishment phase before the investment begins generating returns. Long term loans from 8 to 15 years support more substantial commitments: buildings, storage facilities, livestock housing, processing installations, and the establishment of perennial crops like orchards and vineyards. investments that require years before full productive capacity is reached. Renewable energy installations, solar PV, and biogas systems also fall in this category and are increasingly common as farms diversify their income streams. For the largest, most durable investments, land acquisition, and major infrastructure, extended duration financing of more than 15 years incorporates land mortgage instruments and progressive payment structures that reflect the long timeline before full returns are realized. Rate structures vary. Fixed rates offer planning certainty for long term budgeting. Variable rates with adjustment caps offer potential savings with limited downside risk. Subsidized rates are available through EU and national programs for qualifying investments, which is why aligning your investment planning with EU program cycles is so strategically important. Worth noting, environmental and climate risk assessments are increasingly integrated into loan evaluation frameworks, a trend that will shape eligibility and pricing going forward for agricultural borrowers. Two specialized instruments deserve particular attention because they address very specific and common challenges in agricultural business management. The first is bridge financing. Anyone who has managed EU funded projects knows the problem. You spend money today, but the grant arrives months, sometimes over a year, later. Agricultural bridge financing fills exactly this gap between project expenditure and EU subsidy or grant disbursement. Terms typically range from 3 to 9 months for standard programs, extending to 18 months for complex multi step grants. The repayment source is the grant itself. The approved subsidy entitlement is legally assigned to the lender, which is why rates are typically below standard commercial levels. The quasi-guaranteed repayment source reduces the risk premium significantly. For enterprises that regularly access EU grants, understanding bridge financing is essential. The second specialist instrument is agricultural leasing, which solves a fundamental problem. How do you access expensive technology and equipment without tying up large amounts of capital upfront? Leasing covers tractors, harvesters, milking systems, precision agriculture platforms, logistics equipment, and storage infrastructure. Several structural variants exist. Finance leasing involves eventual ownership transfer. Operating leasing is pure rental with no ownership obligation. Sale, leaseback releases liquidity from existing assets, and seasonal adjusted payment schedules match cash outflows to production cycle revenues. The strategic advantages are significant: reduced upfront capital requirement, operating expense tax treatment, the ability to refresh technology as it evolves, integrated maintenance provisions, and preservation of working capital for operational use. Providers range from bank leasing subsidiaries and manufacturer finance arms to independent specialists and cooperative leasing programs. Beyond commercial banks, there is a long tradition in European agriculture of member owned financial institutions that bridge formal banking and informal lending. Section 3.4.4 looks at agricultural credit cooperatives, their distinctive logic, the models that have developed across Europe, and where they are headed as digital transformation and climate change reshape the financial landscape. Agricultural credit cooperatives are fundamentally different from commercial banks, not just in ownership structure, but in the logic of how they operate and the incentives that drive them. Three main models have developed in Europe. The federated model connects local cooperatives under a regional or national apex institution. This balances member proximity and local knowledge with the capital scale needed to serve larger investment needs. The dominant example is Germany's Volksbanken and Raiffeisenbanken network, one of the most successful cooperative banking systems in the world. The integrated banking model is illustrated by Crédit Agricole in France, an institution that evolved from cooperative roots into a full-service bank while maintaining cooperative governance structures. It remains the largest cooperative banking group in Europe and demonstrates what cooperative finance can become at scale. The community-based model, standalone local cooperatives without network affiliation, offers the strongest social capital and deepest local knowledge, though with more limited capital base and technology capacity. What makes cooperatives genuinely valuable? They are member owned and democratically governed, which means incentives are aligned with member interests rather than external shareholder returns. Deep local knowledge reduces the information asymmetry that makes conventional banks cautious about agricultural lending. Profits are returned as dividends or reinvested in improved member services. Social capital and community dynamics reduce default rates in ways that statistical credit models can't easily replicate. And seasonal credit products are calibrated to crop cycles in ways commercial banks rarely match. The challenges are real: governance capacity gaps, technology infrastructure limitations, increasing competitive pressure from fintech and commercial banks, and the need for new risk models as climate change alters production patterns. Mobile banking and blockchain technologies are extending rural reach, and strategic ag tech partnerships are improving credit scoring for member enterprises. The cooperative model is evolving, and understanding its direction matters for agricultural financing strategy. Not all agricultural financing comes from banks or bank like institutions. Section 3.4.5 explores the landscape of non banking financial institutions, microfinance organizations, input supplier credit, factoring, leasing companies, and investment funds. and and the increasingly significant role they play in filling gaps that conventional banking leaves open, particularly for smallholders and enterprises in their earlier stages. Two instruments are particularly important for smaller agricultural enterprises that face structural barriers to conventional banking. The first is microfinance. In agriculture, microfinance organizations typically provide loans in the range of €1,000 to €25,000, though there is significant regional variation. They offer reduced documentation requirements, simplified underwriting, and sector specific products that respect agricultural cash flow patterns, including harvest linked repayment schedules and seasonal installment products that conventional banks simply don't offer. Rates are generally above conventional banking, reflecting the higher cost of serving this market segment, but the integrated approach, combining finance with technical advisory services, adds value beyond the loan itself. In the EU context, the European Commission actively promotes agricultural microfinance through the European Social Fund Plus guarantee facilities. The landscape is heterogeneous, encompassing NGOs, specialized microfinance institutions, credit cooperatives, and bank subsidiaries. The second instrument is agricultural input supplier credit. Credit extended by seed, fertilizer, and agrochemical suppliers, allowing farmers to acquire inputs now and pay after harvest. It's purpose specific, short term, and carries minimal administrative burden because it's relationship based rather than formally underwritten. Pricing ranges widely, from zero interest promotional arrangements to premium pricing, depending on supplier strategy and market conditions. In Central and Eastern Europe, where formal banking access remains more limited, supplier credit penetration is notably higher and plays a genuinely critical role in enabling production. The European Commission recognizes its complementary function for smaller enterprises facing structural barriers. One important risk to flag explicitly: over reliance on a single input supplier creates dependency and eliminates competitive purchasing, a strategic vulnerability that should be managed deliberately as the enterprise develops. As agricultural enterprises grow and become more integrated into commercial supply chains, a broader set of non banking instruments becomes relevant. Agricultural factoring converts unpaid receivables, invoices from food processors, retailers, exporters, into immediate cash. Instead of waiting 30, 60, or 90 days for payment, the farm sells those invoices to a factoring company at a discount and receives liquidity now. The advantages are significant. It expands liquidity without expanding the balance sheet. Non-recourse factoring transfers debtor default risk away from the farm. It doesn't depend on traditional collateral, and it scales naturally as the business grows and invoice volumes increase. The EBRD actively promotes factoring in emerging European markets, and adoption in Central and Eastern Europe is growing steadily. Agricultural investment funds represent a qualitatively different model, mobilizing institutional and private capital for agricultural ventures. Active examples in Europe include the Black Sea Investment Fund focusing on CEE grain and arable agriculture, Pontifex AgTech for crop science and robotics, Astanor Ventures for sustainable food systems, Five Seasons Ventures for European ag-food tech broadly, and the EIB Agriculture and Bioeconomy Program with a €400 million commitment. Investment horizons in these funds align with agricultural development cycles, and sustainability criteria integration is growing rapidly. Finally, fintech and digital platforms are transforming the accessibility of agricultural finance in ways that matter enormously for rural financial inclusion. Mobile banking is reaching previously excluded rural communities. AI powered credit scoring using satellite imagery and IoT data enables lending decisions without conventional documentation. Blockchain supply chain finance is reducing verification costs and opening new possibilities for value chain financing. EU policy actively supports this transformation through regulatory sandboxes and the FinTech Action Plan. Beyond banks and traditional financial institutions, a new generation of financing mechanisms is reshaping what's possible for agricultural enterprises. Section 3.4.6 explores crowdfunding, private equity, value chain finance, and contract farming, instruments that were marginal a decade ago but are now increasingly relevant, particularly for growth stage farms and agribusinesses with innovation ambitions. Crowdfunding has moved well beyond its origins as a niche funding tool and is now a recognized channel for agricultural finance in Europe with a clear regulatory framework supporting cross border operations. Four distinct models exist, each with different logic and implications for the farm business. Donation based crowdfunding mobilizes philanthropic capital for initiatives with social or environmental objectives. Contributors expect no financial return. It's most common for agroecology projects, heritage breed conservation, and community food initiatives where the mission resonates strongly with the public. Reward based crowdfunding offers non financial incentives, agricultural products, farm experiences, subscription boxes in return for contributions. It's particularly well suited to artisan food production, traditional practices, and regional identity products. It carries a lower regulatory burden than financial crowdfunding and can simultaneously build a loyal customer community. Lending based or peer to peer crowdfunding provides debt financing through digital platforms. This became significantly more structured in Europe with the EU crowdfunding regulation 2020/1503, which created a harmonized cross border framework for campaigns up to €5 million. Platforms like Mimosa in France and Lendahand are active in agricultural lending. Equity based crowdfunding offers ownership stakes in agricultural ventures. It carries the highest regulatory requirements but provides the longest term capital, and it's particularly relevant for growth stage farms and ag tech companies. Platforms like Cedars, Anaxago, and Green Rocket are among the prominent players in European agricultural equity crowdfunding. Choosing the right model depends not just on capital needs, but on the nature of the enterprise, the relationship you want with your funders, and your appetite for ongoing governance and reporting obligations. For agricultural enterprises with significant growth ambitions, particularly those with technology or innovation components, private equity and venture capital represent a qualitatively different category of financing. Investment in European agriculture and ag tech is concentrated in several areas: precision farming and robotics, vertical and controlled environment agriculture, organic production supply chains, food processing innovation, and supply chain integration. Active investment vehicles include the Black Sea Investment Fund for CEE arable agriculture, Pontifex AgTech operating transatlantically, Astanor Ventures in Brussels focused on sustainable food systems, Five Seasons Ventures in Paris, and Yield Lab Europe as an early stage accelerator. These are active ownership models. Investors bring strategic guidance alongside capital, and ESG criteria are increasingly mandatory in investment frameworks, not merely aspirational. For most farms, however, value chain financing and contract farming are more immediately accessible and operationally relevant. The mechanisms vary. Processors may provide inputs, seeds, fertilizer, advanced against future harvest delivery. Tripartite agreements between producer, input supplier, and processor create aligned incentives across the chain. Warehouse receipt financing uses stored crops as collateral, and digital supply chain finance, enabled by blockchain, reduces verification costs and opens new possibilities. Looking at specific European sectors, grain chains offer pre harvest programs through major trading entities. The sugar sector uses integrated contract schemes with input provision and offtake commitments. Poultry and pork involve vertically integrated systems with facility financing. And horticulture often combines equipment provision with quality certification packages. The fundamental advantage of value chain financing is that it embeds capital provision within existing commercial relationships, reducing transaction costs and addressing the information asymmetry that makes conventional lenders cautious. We've now surveyed the full landscape of agricultural financing instruments, from self financing and bank credit to cooperatives, non banking institutions, and alternative mechanisms. Section 3.4.7 brings it all together with the question that matters most in practice. How do you construct a coherent financing strategy from all these options? Moving from knowing what instruments exist to actually building a balanced, resilient financing portfolio is the skill this unit has been building toward. Effective agricultural financing isn't about finding one good loan, it's about constructing a strategy. Let me walk you through a 5 step methodology. Step 1 is financial needs assessment. This means disaggregating your capital requirements into 3 categories: operational needs, working capital for day to day activities, investment needs, capital expenditure to build productive capacity, and strategic needs, financing for expansion or transformation. Equally important is mapping the timing of these requirements against available internal sources and production cycle cash flows. You need to know not just how much capital you need, but precisely when. Step 2 is source diversification. The goal is a balanced portfolio combining traditional and alternative sources, debt and equity, internal and external funding. This reduces dependency on any single financier and significantly improves resilience when credit market conditions tighten. Step 3 is temporal stratification, matching financing instruments to time horizons. Short term instruments for operational inputs, medium term for equipment, long term for land and infrastructure, and critically aligning repayment schedules with the productive life of the assets being financed. Step 4 is risk management integration. This is where insurance, price hedging, and contingency reserves become integral parts of the financing strategy, not separate considerations. Multi-peril crop insurance, forward contracts, futures, and contingency reserves need to be co-designed with your financing approach, not added as an afterthought. Step 5 is credibility building. Transparent financial records maintained to European accounting standards, proactive communication with lenders and banking partners, a consistent repayment track record, and professional association membership. These are the inputs that determine your financing terms over time. Strategy is built through consistent behavior, not just well written documents. This overview brings together everything we've discussed in a single strategic view, mapping each financing source against the 3 main development phases: establishment, growth, and maturity. The pattern it reveals is strategically important. At establishment, self financing and personal capital are the primary source. EU grants, particularly young farmer premiums under CAP, are critical. Conventional bank access is limited, but leasing provides equipment access without the credit history requirements of a full loan. Microfinance and donation or reward based crowdfunding can also play meaningful roles. At the growth phase, short term bank loans become the core instrument for seasonal financing. Medium and long-term investment credit opens up for capital expenditure. Leasing is often preferred for technology assets. EU modernization grants become accessible. Cooperatives, processor links, and lending based crowdfunding complement bank financing. At maturity, retained earnings become the primary internal source. Long term strategic bank credit, factoring, equity based crowdfunding, and investment fund participation all become viable. Value chain financing deepens into strategic integration. The use of this framework isn't prescriptive, it's diagnostic. Where are you in the life cycle? What sources are you currently using? And what should you be building toward? The most resilient farms are not those that found one good financing source. They are those that actively managed the evolution of their financing portfolio as the enterprise developed. Before we reach our conclusions, two final dimensions of strategic sophistication are worth understanding: how to combine financing instruments effectively and how to integrate risk management into the financing strategy. On complementary financing structures, the most effective agricultural financing strategies don't rely on single instruments but on deliberately designed combinations. Some practical examples: pairing an EU grant with commercial bank co-financing means the non-reimbursable component enhances overall project viability and reduces the bank's risk, making the combined package better than either instrument alone. Combining an investment loan for core infrastructure with leasing for technology assets optimizes both the balance sheet and the tax position. Insurance backed credit facilities link crop insurance premium payments to loan collateral, an innovative risk transfer mechanism that benefits both farmer and lender. And layering supplier credit for inputs with microfinance for working capital addresses different needs in the cash flow cycle simultaneously. On risk management, financing strategy and risk strategy must be co designed. Production risks are addressed through multi peril crop and livestock insurance, and through the CAP risk management toolkit. Market and price risks are managed through forward contracts, futures, and currency hedging for export oriented enterprises. Financial risk monitoring uses specific metrics. A debt service coverage ratio of at least 1.25 is the standard benchmark, meaning your earnings should cover debt payments with a margin, and working capital ratios should be tracked regularly. Seasonal cash flow stress testing should be routine, and a contingency reserve of 10 to 15% of annual credit exposure provides a buffer against unexpected events. And institutional credibility, transparent accounting, proactive lender communication, consistent repayment remains the foundation of access to good financing terms over time. Let's close with the 6 key principles from this unit that should stay with you. First, there is no single solution. Every agricultural enterprise needs a tailored financing mix. Capital structure depends on life cycle stage, subsector, risk profile, and the EU instruments available in your specific context. Anyone who tells you there's one right financing approach for agriculture isn't paying attention to the complexity of the sector. Second, subcategory depth matters. Within each financing category, bank credit, cooperatives, non banking institutions, alternatives, specific instruments carry different costs, risks, and strategic implications. Generic knowledge isn't enough for real decisions. You need to understand the difference between a crop lien and a personal guarantee, between a finance lease and an operating lease, between non recourse and recourse factoring. Third, EU instruments are enablers, not standalone solutions. KP, direct payments, EAFRD grants, EIB programs, and financial engineering tools are powerful catalysts for complementary private finance, but they work best as part of a broader strategy, not as a substitute for one. The farms that use EU instruments most effectively are those that treat them as leverage, not as a primary financing model. Fourth, self-financing is the foundation. Building internal financial strength through retained earnings and asset efficiency reduces your external financing costs and signals credibility to every lender and investor you approach. It's not glamorous, but it's what everything else is built on. Fifth, strategy over opportunism. Effective financing is planned, diversified, and aligned with operational cycles. It is not reactive and it should not be based on whichever offer happens to arrive first. The difference between farms that access good financing and those that struggle is often simply that the successful ones approached financing proactively. And sixth, risk management is inseparable from financing strategy. Insurance, hedging, and contingency provisions must be designed together with your financing approach, protecting both your farm and your creditors. Treat them as one integrated discipline, not two separate concerns. If there is one overarching message from this unit, it is this: the farms that thrive over time are not necessarily the ones with the most capital. They are the ones that understand capital, manage it strategically, and build the financial credibility that keeps better options available as they grow. We've covered substantial ground today, from the structural characteristics that make agricultural finance unique to the full range of financing instruments across banks, cooperatives, non banking institutions, and alternative mechanisms to the strategic framework for building a balanced financing portfolio. But let me distill what really matters. Successful agricultural enterprises don't leave their financing to chance. They don't rely on whatever credit becomes available or hope that good production automatically translates to financial sustainability. They combine disciplined financial planning with strategic instrument selection, using the frameworks we've explored together today. Financial strategy in agriculture isn't just about numbers. It's about creating the resilience and adaptability your enterprise needs to navigate biological cycles, market volatility, policy changes, and the unpredictable realities of rural production. Start where you are. If you're in the establishment phase, focus on building your financial credibility and leveraging EU instruments. If you're in growth, prioritize diversification across instrument sources and timelines. If you're at maturity, optimize your financing structure and think about what the next phase of development will require. The next generation of agricultural operations like yours, are combining deep agricultural knowledge with strategic financial management. That combination is powerful. By implementing the approaches from this unit, you're not just building a more resilient business, you're contributing to a more sustainable agricultural sector capable of meeting the challenges ahead. Thank you for your time and commitment. Keep learning and keep building.